Hey everybody, I'm Jack from Pine Analytics, and today I'm going to talk about Solana markets, what people are trading on chain, and kind of what that means for kind of the asset itself and its fundamentals. So let's go. Okay, so all the graphics I'm going to mention in this are just about volume, on-chain volume, in term on DEXs, and the reason that I'm going to reference that metric is because out of all the metrics on chain, TVL, users, stablecoin transfers, it has the highest correlation to on-chain fees that are collected by the validators, and that's very relevant because like that is like the fundamentals of the chain. So that's why I'm going to be referencing on-chain volume the most. So this is kind of a graph of Solana on-chain volume since the start of 2024, and what you can see is that the trend is pretty good. There was a massive spike at the end of last year, at the beginning of this year. It went down and it's recovered a bit. And if you look at the past like 3 weeks, this is like up to midway in August. You can see that that trend is continuing to go up and kind of look in a good direction. So overall, the volume on chain is trending in the right direction. The interesting thing though is when you break that volume down by category, what you see is that the two stackers that completely dominate the on-chain volume on Solana are Sol stable pairs and then meme coins. If you look at in green there, I have RWAs. You can't even see it on the chart because RWAs are basically, their volume is insignificant on Solana compared to a lot of stuff. And then the yellow there is project tokens. So this is tokens of like maybe Camino, Radium, Pump.fun, kind of projects on the chain. And they make up part of the volume, but it's really also insignificant compared to memes. What you can also see is that the memes have kind of ran from the beginning of 2024 to the end of 2024. And they've kind of been declining as a total amount of volume on the chain, but that's still just being eaten up by Sol swaps. So I kind of want to explain why I think this is. So like fundamentally, I want RWAs and project tokens to be making up more of the volume on the chain. But there's kind of a few problems because like, well, first of all, if these are most of the volume, the chain is a lot healthier than if it's just a meme coin casino. So like kind of the first kind of problem with RWAs is that they're new. So like a lot of these stocks, bonds, or kind of other things that are brought onto the chain just don't have a lot of liquidity. So why would you buy it on Solana when you can just buy it in your Fidelity account or something like that? It seems kind of like a roundabout way. Now there's some people in certain jurisdictions who can't get access to it, so that's why they would buy this stuff. And then same reason, because it's a liquid, the slippage is high, so like you're getting bad fills on anything you're buying. And then moving assets on and off chain, most people who are buying stocks have money in traditional accounts, so it's kind of more of a pain for them to get on chain than it is to get into the brokerage or something like that. And Solana isn't the primary trading venue for a lot of these assets. So like there's no reason to go out of your way to get to this liquid venue, right? And that's why RWAs aren't trading so much. For project tokens, there's just a lot of problems with project tokens. They kind of present themselves as equity, but they don't act like it. Insiders kind of dump on people. There's often not a lot of kind of value that goes from the project success to the token. So overall, the reason the project tokens aren't doing too hot is because a lot of project tokens are kind of, I don't know, not great in a lot of ways that they treat their token holders. So like what could change this? So for RWAs, it kind of makes sense that they're illiquid markets right now as like the administration just changed and now like people can actually take them on chain, institutions move slow. So it'll take some time for some of these bigger assets like the stocks or bonds or stuff like that to gain real liquidity and momentum. Then assets need to be minted directly on chain as their primary venue so that if you want to buy a certain asset, you have to go to the chain to buy it. And that will drive a lot of activity because if you can buy something already in your brokerage account, there's kind of no reason to go onto chain for a lot of people. And then certain asset niches need to have their primary liquidity on chain. So there's kind of this new topic called exotic RWAs, which are collectibles, things like Pokemon cards, coins, stuff like that. And the reason they're such great assets for RWAs is because they have really bad trading venues normally. So the on-chain trading of like these cards and collectibles and stuff like that can actually become the primary liquidity venue and where price discovery happens. And so I think these smaller niches are going to kind of be the first RWAs to actually like pick up volume because that's where the trading of these assets are actually happening. And then for the stuff that's not these small niches, it will likely just be slow and move at the speed of institutions, regulation, and stuff like that. But like eventually it will come. Then on the project token side, I think people who launch tokens need to just kind of think about the chain less as exit liquidity and more as like a real place for their basically tokenized equity to kind of live, give value back to their token holders. There probably needs to be more like reporting on these sort of things and clear standards for what's acceptable and not acceptable with project tokens. And I think there's kind of some efforts to kind of do this, like a lot of tokens like Hyperliquid or Pup.Fun are just buying back their tokens with all their revenue. And now that isn't perfect, but that's a lot better than what's been going on in the past. All right, so now that we talked about like what assets are being traded, I'm gonna chat a little bit about who's trading them. So there's been this kind of new concept of proprietary AMMs on Solana. And these are AMMs that are only run by one market maker. And if you look at this chart right here, over 60% of all Sol stable pairs, or Sol USD for this one, is being traded from these proprietary market makers. And the graph doesn't go far back enough, but this is from like almost zero at the beginning of the year. So they've like kind of dominated the Sol trading volume. Another thing you can notice is that they're quite competitive. Like SolFi was making up the whole market, and within a few months, Humidify has taken a lot of it from them, and they're kind of cannibalizing each other. But I want to kind of talk about why these kind of market makers have come onto chain. So the problem with traditional automated market makers is that those apps can't determine how transactions are ordered. And because they can't determine how transactions are ordered, when people put liquidity onto the chain, often they get their stale orders picked, which is kind of like toxic flow. It's kind of bad for market makers because they can't react in time, basically. And as a result of this, they have to have wider spreads and worse fills on a lot of their orders. And then this is a real problem for assets that have their primary price discovery on centralized exchanges and stuff like that. So because these on-chain market makers were having a lot of problems with wide orders, what happened was these proprietary AMMs came out where the AMMs only take orders from aggregators. They don't let arbitrage bots hit their pools. They don't have public front ends. Nobody can directly go and trade on them. They don't take public liquidity, so you can't liquidity provide using these AMMs. And they only execute through, I think I already said that. They already execute through aggregators. So basically, they've come up with this kind of new way of providing liquidity. And the reason that this is advantageous is that because nobody's picking their orders and giving them toxic flow, they can have tighter spreads than the on-chain market makers, which means that they'll give consumers better prices almost every time. And so because of kind of this dynamic, they've come to like dominate trading for these larger pairs. So where do traditional DEXs still play a role? So these assets right here, so Humidify, the largest prop AM right now, these 6 assets are the only assets that they trade. But in the assets that they trade, they dominate. And so what kind of funny thing here is that they trade Sol stablecoins and then meme coins, which kind of shows that the market structure of some of these meme coins is actually more developed than the market structure of some of these project tokens. But where traditional DEXs play a role is in basically smaller markets that there's more price discovery happening, markets that are less efficient, and markets that where native activities on Solana. So for larger assets where price discovery is happening on centralized exchanges, prop AMMs dominate, but then for these newer assets, meme coins, project tokens, stuff where I guess the market's less developed, that's where traditional AMMs kind of still stand a chance. And then kind of what I see going forward based on these kind of topics in the market. So the first thing is drift versus Hyperliquid. So right now, Hyperliquid is kind of eating the lunch of like drift and all these other on-chain perp products. And one problem of this is that Hyperliquid has better ways, like to allow market makers to cancel their orders, which allow them to give tighter spreads. But one thing I kind of see coming soon is that these prop AMMs that right now only operate on spot markets will start operating on perps markets on Solana, so that the perps markets on Solana get tighter fills and are a little bit more competitive against hyperliquid. The next thing is, as I was alluding to before, like more exotic RWAs coming onto chain, Pokemon cards, video game skins, like in-person coins, and then maybe some more like exotic debt or exotic like debt and stuff like that that doesn't have a huge market, and the on-chain can kind of absorb the total so that price discovery happens on-chain. Then for project tokens, I chose these two tokens to kind of chat about. So pump.fun, basically all of the revenue right now goes just to buying back the token. So as more kind of project tokens decide that they're actually going to give value to their token holders, I think that will be really good for project tokens, increase their volume on chain, and actually make them like assets people want to hold. And then MetaDAO is doing something a little bit different, but they're a governance platform, and they're kind of, it's kind of too complicated to go in right now, but they basically focus on giving token holders rights to the treasury in a way that the team can't just pull it out. And so as more kind of projects either buy back their tokens or give their token holders kind of real rights to their treasuries, not just like voting rights, I think a lot of these project tokens will kind of take off a little bit more. And then the last thing is like the new Solana Op and Glow upgrade, which reduces finality on chain. This will reduce the advantages that some of these prop AMMs have, but it still seems like they'll still kind of be advantageous over normal AMMs for a lot of the trading of these like Solana stable pairs and stuff like that, but the advantage will reduce, and they'll probably kind of shrink as a percentage of the total market share. So yeah, that was my chat. If you found anything I was working on interesting, just shoot a DM to Pine Analytics, and we kind of help you figure out what's going on chain.